In this lecture, we will take a look at how to analyze some of the financial consequences of marketing decisions. In particular, we will review a very important technique called break-even analysis that everyone who runs a business should be familiar with. Break-even analysis allows you to analyze your costs and understand what your sales need to be in order to be profitable. This is a very basic review of definitions of costs and profits. If you're already familiar with the concepts of fixed cost, variable cost, revenues, and profits, feel free to skip ahead to the next module. Fixed cost refers to a cost that does not change regardless of how much you produce or sell. In other words, it is fixed regardless of quantity. Variable cost per unit is a cost that is incurred each time you make 1 unit of the product. The more you produce, the greater the total variable cost. It includes the cost of raw materials and labor. Profit is the difference between total revenues, that is sales, and total costs. The total revenue is simply the selling price per unit, P, multiplied by the number of units sold, Q. Total cost has 2 components, fixed cost and total variable cost. Total variable cost, of course, is the variable cost per unit multiplied by the number of units sold. Let's take a simple example to see how profit is calculated. Let's say you have a specialty hot dog stand in a food market. The rental for your spot is $100 per day. You sell hot dogs at $4 each, and you sell 50 hot dogs in 1 day. Let's first assume that your mother, who is very generous, gives you all the raw materials and supplies for free. What profit will you make? First, let's note that your only cost, the space rental, is a fixed cost because you have to pay it regardless of whether you sell any hot dogs at all. Your profit is the difference between revenues and costs. You sell 50 hot dogs at $4 each, so your revenues are 50 times 4, or $200. Your costs are the fixed cost of the rental, $100, so the difference between revenues and costs is $100. That's your profit. Now let's take a different scenario. Let's say you decide to pay for your own raw materials, hot dogs, buns, relish, mustard, etc. Together these raw materials cost $2 per hot dog. What is your profit in this case? Now, in addition to the fixed cost, you have a variable cost as well. This variable cost is $2 per hot dog. So now your profit from making and selling 50 hot dogs will be your revenues, $4 per hot dog times 50, from which you subtract your variable costs, which are $2 per hot dog times 50 hot dogs, and your fixed cost of $100. Since the quantity 50 is common to the first 2 terms, you can rearrange the terms and write it out as price $4 minus the variable cost $2 times 50. This expression, price minus variable cost, is what we call the contribution per unit, and it is really important to our calculations, as you will see in the next module. So once we calculate the profit, it turns out to be 0. This is what we call a break-even point. In other words, in this example, if you sell 50 hot dogs, you will just break even, that is, make no profit and make no loss. That ends Module 1. Click on the next video to continue.